Hi guys, my name is Justin Carbonell. I'm Vice President at Validea. In this webinar, we're going to spend some time looking at various tools, features, and resources on Validea that I think might be helpful to you in today's market. As you know, stocks have come off significantly from their highs just 30 trading days ago. As of today, the recording of this webinar, the Dow Jones Industrial Average is down almost 40% from its peak. And there's a lot more pain under the surface in specific segments and areas of the market. We're going to use this opportunity to look at various parts of Validea that might be helpful in terms of managing risk, but also finding new investment ideas. So I hope you get some value from this and find the parts of Validea that fit best into your long-term investment strategy. So with that, let's get right into it. The first thing I'm going to show you is under ETFs, and I'm going to click our risk managed ETF portfolios. What we've done here is created a series of ETF model portfolios that combine asset allocation techniques, along with momentum and trend following concepts and correlation analysis in some cases, to develop strategies or model portfolios that look to manage and balance risk along with generating good long-term returns over time. The strategies we run include the following: the protective asset allocation model, the modified permanent portfolio, generalized protective momentum, the modified all-weather portfolio, permanent portfolio, all-weather portfolio, and the robust asset allocation model. What you can do on this page is see how these strategies have performed over various time frames. So you can see the long-term performance, which we were able to test these strategies back to 2006. So we have the 2008 and early 2009 bear market, and then the subsequent bull market. And then obviously this year, which has been very painful, we can see how these strategies have done this year so far and how they have performed and delivered on managing risk. You can toggle between those various performance dates using the drop-down. Anytime you see a portfolio name, you can click into the portfolio to see the details behind it. So let's do that. I'm going to click on the protective asset allocation strategy. So at the top of the page, what you're going to see is the details behind what goes into the strategy. So in this case, the strategy invests in the asset classes with the highest momentum using a selection of 12 ETFs. The asset classes covered are the S&P 500, the Russell 2000, the NASDAQ 100, European equities, Japanese equities, emerging market equities, long-term treasury bonds, high-yield bonds, corporate bonds, commodities, gold, and real estate. The strategy will invest in the 6 asset classes with the strongest momentum on the rebalancing date. It will also move toward a crash protection asset, intermediate term bonds, as the number of asset classes that are in a downtrend rises. Once more than half the assets in the selection universe are in a downtrend, the portfolio will invest 100% of its value in crash protection. So on each of these ETF model portfolio pages, at the top, you're going to see an overview of what actually goes into the construction of the model. As you scroll down the page, you'll see a long-term performance chart. You can always click on the full return history link to see the calendar year performance, so you can see how this strategy is done year by year and see if it meets your standards for potentially allocating to the model. As you come down, you're going to see the portfolio holdings, along with the ability to change the date to see how the portfolio was positioned at any point in time historically. And then you'll also see the latest changes. So the latest rebalancing was on March 6th. The next rebalancing is on April 3rd of 2020. But what you're seeing here is the latest changes to the portfolio. When these portfolios are rebalanced, which is on a monthly basis, we're going to notify you, letting you know what's coming in and what's coming out of the portfolio. Not all the portfolios in the ETF risk managed portfolios have changes each month. Some of them do, some of them don't. But the point is that we make it very clear and transparent as to what's coming in and what's coming out. So the ETF models certainly are appropriate for investors that are looking to control risk, downside risk in particular, but they also want to incorporate other asset classes like stocks, like commodities, and things that are working at different points in time in the market cycle. These strategies can give you the ability to integrate those into a disciplined, systematic investment strategy. And we run these on Validea for our subscribers. The next feature I'd like to show you is our Guru Stock Screener. So we're moving more to individual stock selection and investment ideas here. But what I want to just do is demonstrate a few ways that you might use the Guru Stock Screener in today's market environment. So let's say we want to find stocks that pass at least a few of our investment strategies. So as many people know, we run strategies on the stock selection side based on great investors and other demonstratable methods. So we run 22 different investment models based on the likes of Warren Buffett, Peter Lynch, Ben Graham, Joel Greenblatt, and a host of academic papers and other strategies extracted from books. These are, for the most part, fundamental-based strategies that look at a wide range of different financial metrics and variables to identify stocks that score highly according to each one of the strategies. So what we can do using the Guru Stock Screener is we can look for stocks that say pass at least 4 gurus with strong or some interest. This would give us stocks that pass at least 4 of our Guru strategies with at least an 80% score. When we add that criteria, we get a very long list of stocks here that pass at least 4 strategies. So this is probably way too much for any person to deal with. And it's not really a manageable set of data. But let's say we wanted to say, okay, of this list, I want to see stocks that have just been clobbered. I really want to go in and find the stocks that I think have been sold off so much that they look way too cheap and they're down way too much given what I think is going to happen in the market and what I think is going to happen with some of these businesses. So what we can do is we can use, this is just a very simple filter, we can use the percent below the 52-week high, and let's just say we want to find stocks that are down at least 70% from their 52-week high. We can add that criteria in. This gives us a much shorter list. Some of these names you'll be familiar with: KB Home, Abercrombie and Fitch, Michael Stores, Michael Companies, Discover, Kohl's. So that's how you can use the Guru Screener to really find stocks that have seen massive price decline, stocks that might be being unfairly thrown out and just discounted like they're going out of business. Obviously, what's going on in the market and what's going to happen on the back end of this, there will be companies that are probably permanently impaired, but many of them will not be. And so trying to uncover those now could be where you could get some really good returns as we come out of the period we're in. There's a lot of other criteria you can integrate into these screens. You can add simple things like market cap, advanced, what I would consider a little bit more advanced valuation metrics like enterprise value to EBITDA, shareholder yield, liquidation value to price. There's some growth and profitability metrics you can add in here, quality and ownership criteria. So the Guru Stock Screener really is a way for you to uncover stocks that you think are good investment opportunities, but you can back into them by adding your own criteria in. I just used the percent below the 52-week high because given how dramatic this sell-off has been for certain parts of the market, there are some really, really interesting opportunities, I think, in the stocks that have been sold off the most. And a lot of investors are attracted to those opportunities. So using our Guru Stock Screener, you might be able to find the ones that are going to come out of this and really be great performing stocks in the future. The next feature on the site I want to show you is our factor report. This is a new addition to the Validea site, but I think it can be helpful for investors during periods like this. So what our factor report does is it analyzes any stock using the major investing factors, including value, quality, momentum, and low volatility. So here we're looking at Microsoft. And what this page shows you is how Microsoft scores and ranks given its factor exposures. So we can see how, based on value, quality, negative quality, total momentum, and low volatility, how the stock actually stacks up. The areas that I think can be useful in today's type of market environment are a few on this page. So let's talk about quality for a moment. In periods like this, investors tend to gravitate towards higher quality stocks. In this case, as we can see, Microsoft scores very highly based on this quality composite score. Our quality composite score takes into consideration return on equity, return on capital, gross margins, net margins, sales consistency, and EPS consistency. In times of uncertainty, quality companies may have the ability to hold up better, and investors can use this report to see if the stocks you own or you're interested in score high based on quality. The two other areas that I think are important here are the total momentum. So the total momentum rank and score shows you how stocks stack up based on their price momentum and their fundamental momentum or trend. This will give you an indication of relative to other stocks. How is the stock performing from a price standpoint? And also, are its fundamentals trending positively versus others? In this case, Microsoft, again, scores very highly. So that's a positive. Lastly, this report, you can see the low volatility composite score, which takes into consideration the standard deviation and the beta of the stock. Again, in times where stocks are selling off and there's a big difference between, the stocks that are performing well and those that are really getting hit hard, stocks that are exhibiting low volatility do tend to hold up better given the underlying characteristics of the firm in these types of market environments. So that's how an investor might be able to use our factor report in terms of finding stocks or looking at the stocks they own and they hold, and also the ones they're interested in, to see how these stack up based on these different investing factors and some of the ones you may want to pay particular attention to in this type of market environment. Okay, I'm going to move on now to our trend following tool. This is not on the individual stock selection side. This is more of a trend following or a technical system that we've developed that is used to move in and out of stocks and other asset classes when the technical conditions warrant a change. The goal here is to limit losses during major downturns across these asset and investment classes, while at the same time providing a mechanism or a way to get back into these asset and investment classes once the positive momentum reasserts itself. We run our trend following system on 45 major asset and investment classes and our guru-based strategies. So what this table is showing you across major asset classes, as well as our guru portfolios, different investing styles, and the major sectors in the market, is whether or not the current asset class or investment class is either in buy or sell mode based on our trend following system. One of the things that has started to happen over the last 2 weeks because of the decline in the market is we've started to see more sell signals pop up. So as you can see in the current signal column, there's certainly still some buys, but the sells are starting to emerge as well. And that's new. I mean, we were, as a couple weeks ago, we were definitely almost all in buy category here, but the sells have started to emerge now that a lot of these asset classes and investment classes have violated key moving averages, and we use multiple moving averages in our trend following system to determine whether or not we are in buy or sell mode. When you click into any of these asset or investment classes, what we're going to show you on the more detailed page is the following. We're going to show you what the current signal is, so whether it's a buy or a sell. We're going to show you when the last signal change was. You can also see the full signal history, so you can get a sense of how active, how many times has this signal been kicked off for this asset or investment classes historically. That's a valuable thing. It allows you to see how it's reacted in certain market environments. We then show you a couple moving averages below that are important in this system, so stuff like the 50-day and the 200-day moving average, and where we stand according to those averages. Then coming down below, you can see the full performance chart for the asset or investment class you're looking at. We try to go back as far as we can in looking at how trend following has performed versus buy and hold. And then we chart not only the long-term annualized returns of trend following versus buy and hold, but we show you the 5-year and the 3-year numbers of those two things. And then also we report the maximum loss or maximum drawdown versus the maximum loss or maximum drawdown for a buy and hold type strategy on the asset or investment class. With trend following, what I would say is, investors need to understand the realities of trend following systems, which none are perfect. They're definitely susceptible to getting whipsawed. That can happen. For example, if you think about back to December of 2018, just thinking about the U.S. equity market, the market almost saw a 20% decline from the fall of 2018 up until like December 24th or late December, and then it basically turned on a dime. So trend following systems that were selling in, let's say, early to mid-December, they got caught there, and when the market went higher and just pulled out of that downturn, trend following systems were having a hard time because they had to follow it back in. In this most recent decline, it's going to be interesting to see, what's happening here is some of these trend following systems are basically generating a sell trigger. So if the market goes down further, these trend following signals will be right. if the market sort of bottoms here and takes off and we get this explosion out, if things maybe aren't as bad as they look, then the trend following systems are going to be having to chase it back in. So those are just things to think about when utilizing a trend following system, because you want to understand the weaknesses of them so that when they do exhibit those things, you aren't, questioning their viability, but you're understanding sort of the pluses and minuses when you try to implement one of these things in your own investment strategy. The last thing I'd like to show you is something that's not as tactical, although I think it could be used, but it's certainly something that's a little bit unique to Validea, and it's our market valuation tool. And what this allows you to do is quite simply see the current valuation on the market or segments of the market through multiple valuation lenses, and allows you to compare it to a historical sort of context or where we've been historically. So when you come into this page for the first time, what you're seeing is the valuation of all stocks based on the median trailing 12-month PE ratio. So that's looking at the trailing 12 months and saying what is the valuation of the market based on the PE ratio versus to where we've been historically. So we chart this back to late 2005. That's as far back as we can go. Obviously, when you look at this chart, you see valuations came way down at the end of 08, early 09. Then they've been trending up. They peaked, at least in this cycle, at almost 25 times earnings in early 2018. And then they kind of started to trend down. And what you're going to see here, it's kind of hard to see in the chart, but this waterfall decline that we've had recently has brought the valuation, at least based on the trailing 12-month PE, down pretty significantly. So we've dropped from earlier in the year to around 21 to about 14 today. And we look at the valuation through multiple lenses. So it's the trailing 12-month PE, the CAPE ratio, the current year PE, price to sales, price to book, and price to cash flow. So as a user, you can play around with that depending on the valuation metric that you value the most to see where the market stands. One of the things that we also allow you to do is compare segments of the market. So one of the interesting things we're seeing now, and it's kind of been happening for a little while, but it's even more pronounced today, given the recent sell-off, is when we look at the valuation of small and mid-cap, what we would consider value stocks, and we look at the relative valuation or the spread, let's say between mega-cap growth stocks, which have been some of the best performers, really over the last 5 years, but their valuations are much higher. We see that, at least using trailing 12-month PE, so we're just using the PE ratio here, that the valuation spread is wide. So small caps have almost never been cheaper, at least in the 15 years we've been looking at the data. Small mid cap value is almost the cheapest it's ever been relative to mega cap growth. And the reason that's important for investors going forward is because valuation, while it's not perfect and it's not a short-term timing mechanism, it can be powerful for long-term returns. And so what our market valuation tool may allow you to do is allocate, tilt, and have your portfolios more oriented to where the value is in today's market. And our market valuation tool allows you to see that. So again, all we wanted to do in this webinar was showcase a few of the various tools on Validea that may help specifically in this market environment. This isn't to minimize the losses that have taken place, and investors obviously have felt a tremendous amount of pain when they look at their portfolios and see their investment portfolios, if they're in an all stock portfolio, down 35, 40, maybe even 50% if you've been in some areas of the market. But tools like this can be helpful. And I think that the important thing for investors to realize is we will pull out of this. We will get better. And there are some great opportunities out there. It's about finding the strategies that are best for you, that you can stick with, that you believe in, and taking a long-term view. If you can do that, then you'll have a large part of the equation answered, and there will be better times ahead. So thank you for listening. We hope you enjoyed this discussion, this webinar. If you have any questions, just email us. You can email us directly at info@validea.com. Thank you so much. We hope to see you on Validea.